Hello and welcome to this video. In this video, we are going to do a question from paper 4, variant 41 and 42, May-June 2023, question 2. The question says that ADPLC makes one type of product, the demand for which is highly seasonal. The sales manager estimated that the demand in the coming months beginning December would be as follows. Month and units: December 5,800, January 6,000, Feb 8,400, March 12,800, April 11,800, May 9,600. It was the policy of the company to maintain the inventory of finished goods at maximum 25% of the following month's sales. Sometimes it was not possible for the business to produce enough units in the month both to meet the demand from the customers and maintain the desired level of closing inventory. At these times, the business treated the meeting of demand as more important than maintaining the closing inventory. The maximum number of units which could be produced in 1 month was 10,000. In the A bit of the question, we are asked to prepare the production budget in units for each of the month from January to April. So we'll start with the working notes. You see, in the month of January, the closing inventory, which is on 31st of December, will be the opening inventory for the month of January. And it was mentioned the closing inventory for every month will be 25% of the sales of the next month. So the sales of January, which was given as 6,000, 25% of that will be the closing inventory for the month of December, and the same will be the opening inventory for the month of January. So 6,000 times 25% is 1,500 units. And the closing inventory for the month of January will be 25% of the sales of the Feb, which is 8,400 times 25%, and that will be 2,100 units. Now let's make the production budget, in which we take the opening inventory. To this we add the production, we get the total. From there we subtract the sales and we get the closing inventory. Now we know the closing inventory, which is 2,100 units. We know the sales, which is 6,000 units. We don't know the units produced, so we don't know this total. So how we are going to get this total? We'll formulate it like this. That is, if this is 2,100, how we get this? We take this and from there we subtract this, so we get this closing inventory. So the total we don't know, and we know this is 6,000, which are sales, so we are subtracting that and we'll get the closing inventory as 2,100 units. So if we formulate this in this formula, X will equal to, that is, this total will be equal to 2,100 plus 6,000, and we will get this value of total as 8,100 units. Now when we proceed and further calculate to find the units produced, how we get this? We total this to get the total now. So now we are going to take this, that is 8,100, which is the total, and this is equals to the unit produced or the production, and plus 1,500 units. So if we find the unit produced, it will be 8,100, and we'll take this 1,500 to the other side, it will be 6,600 units. And we can make a formula for this based on this. What we did here, we took the closing inventory, to this we added the sale, and then here what we are doing, we are taking this total which we got, and from there we are subtracting the opening inventory. So we can use this, that is, unit produced is equals to closing inventory plus sales minus opening inventory, will get the same value. Why we are making this formula? Because we can use this for the next month, that is for Feb, March and April. Now for the month of Feb, the closing inventory which we have calculated for the month of January as 2,100 units, which was the sales of Feb, which is 8,400 units times 25%, we got this as 2,100 units, will be the opening inventory for the month of Feb. And the closing inventory for the month of Feb will be 25% of March sale, which is given as 12,800 units times 25%, and it will be 3,200 units. And the unit produced, we have made the formula how we are going to calculate it. Unit produced is equals to the closing inventory plus the sales minus the opening inventory. The closing inventory which we got here is 3,200 units plus the sales of Feb, is 8,400 units, and the opening inventory which we brought forward from the month of January was 2,100 units, so we'll get the value as 9,500 units. Now when we make the production budget for the month of Feb, it will be opening inventory of 2,100 units, and to this we add the production, that is unit produced, as 9,500 units. We'll get the total as 11,600 units. From there we subtract the sales of 8,400 units, and we will get the closing inventory of 3,200 units. In the month of March, the closing inventory of Feb, which we have calculated as 3,200 units, which was 25% of March sale, which was 12,800 times 25%, and we got this as 3,200 units, will be the opening inventory for the month of March. Now when we calculate the closing inventory for the month of March, it will be 25% of April sale, which was given as 11,800 times 25%, and we'll get this value as 2,950 units. Now if we calculate the unit produced in the same way as we have calculated till now, it will be equal to closing inventory plus sales minus the opening inventory. The closing inventory which we have calculated here is 2,950 units, and the sales which was given was 12,800 units. From there, if we subtract the opening inventory, it is 3,200 units which we have bought from the month of Feb. So we'll get the value as 12,550 units. However, we have a constraint that we cannot produce more than 10,000 units. So based on this constraint, what we have to do is, it was given that we have to change the closing inventory. So now we'll change the closing inventory. Our constraint is we can produce only 10,000 units. We don't know the closing inventory. We know the sales which is given as 12,800 units, and the opening inventory which was given as 3,200 units. Now if we transpose this to the other side, we get x is equals to 10,000 plus 3,200. Here it's in subtraction, on the other side it will be in addition, and this 12,800 here it is in addition, and when we transpose it to the other side it will be in subtraction. So now we will have 10,000 plus 3,200 minus 12,800. We will get the closing inventory as 400 units. Now we will make the production budget for the month of March, which is 3,200 will be the opening inventory which we have bought from the month of Feb. To this we will add the units which we have produced as 10,000 units based on our constant. Then we add this 2, will get 13,200 units, and from there we will subtract the sales of 12,800 units. We will get the closing inventory as 400 units. Now for the month of April, we will bring forward the closing inventory from the month of March, and this will be the opening inventory for the month of April, which was 400 units, and the closing inventory for the month of April will be 25% of May sale, that is 9,600 times 25%. We'll get the value as 2,400 units. Now let's calculate the unit produced, which will be equal to the closing inventory plus sales minus the opening inventory. So our closing inventory which we got here is 2,400 units. The sales which was given was 11,800 units, and the opening inventory was 400 units. So this will be equal to 13,800 units. Again, we have a constraint that we cannot produce more than 10,000 units. So if we change this, it will be 10,000 units is equals to, we don't know the closing inventory now, plus the sales is 11,800 minus the opening inventory is 400. We will get x is equals to 10,000 plus 400 minus 11,800, which will be equal to 1,400, which is negative. You see, negative means we can't have any goods in terms of negative. Like suppose if we say we have a pen, okay, we can have one pen, we can have two pen, we can have any number of pens, or we may not have any pen at all, that is we have 0 pens, but we can't make the pen negative, isn't it? We can't say we have -1 pen, -2 pen. It doesn't make sense, isn't it? Because we can't have goods in negative value. So for this reason, we'll make our closing inventory equal to 0. That is, we don't have any closing inventory or any goods as closing inventory. So now we have to change the sales because we are not able to produce the required amount of units to sell the goods which we have estimated. So now we are going to reduce the sales by this negative value, that is 11,800 minus 1,400, which will be 10,400 units. Or what we can do is sales is equals to unit produced, which will be 10,000 because that's our constant, plus the opening inventory, which is 400. So we'll get the value as 10,400 units. Now let's complete the budget for the month of April, which will be the opening inventory of 400 units plus the production of 10,000 units, and this total will be 10,400 units. Our sales will be 10,400 units, which will be subtracted from the total, and we'll get the closing inventory as 0. With this, we have completed this bit. In the B bit of the question, we are asked to explain how the budgeted revenue for the 4 months from January to April should be calculated. You see, we calculate the revenue by taking units sold times the selling price. So we take the units sold and we multiply it with the selling price. We get the sales revenue or the revenue. And sales are usually equated to the demand because whatever is demanded for, we sell. However, here we have a constraint on our production, especially in the month of April. We were not able to fulfill the demand and we sold less. So sales and demand may not always be equal. However, the sales revenue or the revenue is always equal to units sold times the selling price. Furthermore, additional information is given, which is at present the storage space is limited such that the maximum number of units which can be held in the inventory is 3,200 units. In the C bit of the question, we are asked to advise the directors of the company whether or not they should invest in new larger storage facility, and we have to justify our answer. If ADPLC invests in a larger storage facility, then what happens is they can have more inventory available with them, and when they have more inventory available with them, they can use this at the time of peak season when the demand is quite high. Like in the month of Feb, they were able to produce this 3,200 units as a closing inventory, and if the circumstances were favorable, they could have exceeded this production and they could have stored more of the goods in the form of inventory, and this could have been used in the month of April where they would not have lost their sales. Apart from that, when ADPLC have huge storage facility, this will reduce the dependency of ADPLC on the suppliers because the inventory is already stocked up, hence there may be lesser dependency on the suppliers. However, there are a lot of drawbacks for this kind of investment where they invest more on the new larger facility. Like the cost of purchasing this new larger facility may exceed the profit which has foregone on the loss of sales. Apart from that, when the working capital is tied up in the form of inventory, then they will have lesser liquid assets available with them, and this may lead to cash flow problem, and this will also increase the storage cost, and furthermore this can lead to more damaged goods, or the goods may get stolen or may become obsolete, and this may also lead to more losses. And what I suggest is that they should concentrate more on increasing the production. Why? Because ADPLC lost the sales not because of having a smaller storage facility, but it was because they had a constraint on production. They were able to produce only 10,000 units, and when they had this constraint, because of this, in the month of March they were not having sufficient closing inventory, and this led to the loss of sales in the month of April. So if they concentrate more on increasing the production and invest more on increasing the production rather than buying a new storage facility, this will be more beneficial for ADPLC. Furthermore, additional information is provided. Each unit requires 2 kg of direct material. The production manager expects that this material will cost $6 per kilo in January and $7 per kilo thereafter. No inventory of direct material is kept. Half of the purchases are paid for in the month of purchase. The remainder are paid for in the following month. In the debate of the question, we are asked to prepare the trade payables budget for each of the month of Feb and March. Include the balance of trade payable at the beginning and the end of each month. Assume the production is still as in your answer of part A. Now let's do our calculation in our working notes. We'll start with the direct material for January. In January, the units produced and sold was 6,600 units. and we require 2 kilos of direct material, and the cost will be $6 for January. So when we take this 6,600 units times 2 kilos times $6, it will be $79,200. Half of this will be paid in the month of January, that is 39,600, and the remaining half will be the opening balance for the month of Feb, because the remainder will be paid in the following month. So in the month of Feb, this will be the opening balance. Now let's calculate the direct material for the month of Feb. The purchases as well as the production and sales was 9,500 units for Feb, and we required 2 kilos of direct material, and after Jan we have the value of direct material is $7, so times 7 will be $133,000. Half of this will be paid in the month of Feb, which will be $66,500, and the remaining half will be the closing balance, and this will be paid in the month of March. Now for the month of March, the opening trade payable will be the closing trade payable of Feb, and we have calculated half of this, that is 133,000 times half, we will get $66,500, and half was paid in the month of Feb, and the remaining half will be paid in the month of March, and this will be the opening balance for the month of March. Then the purchases, the units produced and sold was 10,000, and we require 2 kilos of direct material for each unit, and the cost per kilo is $7, so it will be $140,000, and out of this half will be paid in the month of March, which will be $70,000, and the remaining half will be the closing balance for the month of March, which will be paid in the next month. Now let's make the trade payable budget. We will start with the month of Feb, where we have the opening trade payables as $39,600. This was the trade payables which we have bought forward from the month of January, and to this we add the purchases, which is $133,000. So when we total this up, it will be $172,600. From this we will subtract the trade payable which we have paid for the month of January, which was $39,600, and the trade payable which we have paid for the month of February, which was half of the total amount, and this was $66,500. So when we subtract this, we will be left with the closing trade payable for the month of February as $66,500, and this will be the opening trade payable for the month of March, which will be $66,500. And to this we add the purchases which we have calculated as $140,000. We'll get the total as $206,500. From this we will subtract the trade payables for the previous month, that is for the Feb, which we have paid is $66,500, and for the month of March, which we have paid $70,000, which will be the half of the trade payable. Then we will get the closing trade payable for the month of March as $70,000. Next, additional information is given which states the directors are considering asking the company's supplier to introduce a cash discount of 4% on the payment made in the month of purchase. In the EBIT of the question, we are asked to explain how this change would affect the budgeted statement of profit or loss. You see, this cash discount will be treated as the discount received, and how we are going to treat this discount received in the statement of profit or loss. First, we'll do the trading part of the profit or loss, where we calculate the cost of sales and gross profit, and we don't include the discount received in this part of the statement of profit or loss. But after the calculation of gross profit, we add this discount received. Hence, there will be no change in the cost of sales or gross profit. However, the budgeted profit will be increased by 2%, because we will add this discount received after calculation of gross profit, and then we calculate the profit for the year. Now why this 2%? Because here we are just paying the half of the payment of the purchases, hence half of the 4% will be the 2%, and our budgeted profit will increase by 2%. With this, we have completed this question. Thanks for watching my videos and have a blessed life.